There is a massive mathematical anomaly happening in the market right now, and retail investors are completely missing it. Wall Street is currently hyper-focused on short-term integration costs and balance sheet debt. As a result, algorithmic traders are punishing one of the most reliable companies on the planet. But while retail panics, the smart money is quietly accumulating shares. Today we are looking at Amcor, ticker symbol AMCR. They just closed a historic $24 billion monopoly tier merger. The market is pricing in fear, but the math reveals a $3 billion free cash flow machine. Welcome back to StockScope. Let's expose the blind spot. To understand the opportunity, you first have to understand the sheer scale of what just happened. Amcor successfully closed its all-stock acquisition of Berry Global. This didn't just create a bigger packaging company, it created a global infrastructure provider. We're talking about a combined entity that now commands $24 billion in annual revenue. They operate nearly 400 production sites across 140 countries, backed by a massive workforce of 70,000 employees. They are the undisputed global leader in consumer and healthcare packaging. But the market is ignoring this dominance. Why? Because of what we call the free cash flow disconnect. Wall Street analysts are terrified of the debt taken on during the merger. But institutional investors, the smart money, don't trade on GAAP earnings alone. They trade on cash. And the cash generation here is staggering. Management is projecting that by fiscal year 2028, this combined entity will produce over $3 billion in annual free cash flow. At its current valuation, the stock is trading at a severe, irrational discount to its intrinsic cash flow multiple. That cash flow isn't just a hopeful projection. It's backed by a ruthlessly efficient integration plan. Management has legally identified $650 million in pre-tax synergies. They are combining supply chains, optimizing growth, and cutting redundant financial waste. In fiscal year 26 alone, they are on track to realize $260 million of those savings. What does that mean for shareholders? It means an immediate 12 to 17% growth in adjusted EPS and a massive 35% accretion to adjusted cash EPS. This is a synergy engine that immediately rewards dip buyers. Now, to address the elephant in the room, the debt. Management isn't just going to let that leverage sit there. They are actively executing a portfolio optimization strategy, identifying $2.5 billion in non-core businesses that will be divested. This influx of capital will be used to rapidly pay down the debt acquired from Berry Global. It's a textbook maneuver to clean up the balance sheet and drastically improve their return on invested capital. Beyond the balance sheet mechanics, the actual underlying business is a fortress. Unlike tech stocks or cyclical industrials, Amcor's revenue is virtually recession-proof. They manufacture the essential flexible films, healthcare closures, and food packaging that global supply chains simply must consume every single day. It doesn't matter if inflation spikes or if consumer discretionary spending drops. Hospitals still need sterile medical supplies, and people still need food. This guarantees an incredibly inelastic revenue stream. Add to that inelastic demand their massive, newly combined R&D budget. Amcor now holds an unassailable lead in sustainable, recyclable material science. As global ESG regulations tighten and governments crack down on single-use plastics, massive consumer brands have absolutely no choice but to rely on Amcor's patented packaging solutions to stay compliant. They aren't just selling plastic, they are selling regulatory compliance at a global scale. Let's remain completely objective and weigh the bear case, which is what is driving the current retail fear. It comes down to three specific risks. First, a spike to over $15 billion in long-term debt, which automatically triggers risk-off selling from macro funds. Second, $280 million in one-time integration costs, creating operational friction across 140 countries. And third, the amortization of intangible assets from Berry Global, which is artificially crushing short-term GAAP margins on paper. But the bull case, the smart money reality, takes the exact opposite side of that trade. First, that $3 billion free cash flow disconnect makes the stock undeniably and irrationally cheap. Second, the $650 million synergy engine is actively driving 35% cash EPS accretion, creating immense shareholder value. And third, they have built an unassailable monopoly moat with inelastic daily consumption demand that will survive any macroeconomic downturn. This dynamic creates Wall Street's ultimate blind spot. Algorithmic traders scan for GAAP earnings misses and hit the sell button. Institutional cash flow investors step in and buy those exact shares. And the best part? While you wait for the broader market to realize its mistake, Amcor provides a, quote, Dividend Fortress. They pay an annual dividend of 51 cents per share, which translates to a highly secured 5.10% dividend yield. You are getting paid over 5% just to hold a global monopoly, while the synergies are realized. Looking at the technical chart on your screen, the price action visually confirms our fundamental thesis. The stock has been trading at a severe discount to its intrinsic cash flow multiple. But I want you to pay close attention to the graphic overlaid on this chart, the insider buying activity. Look at these clusters of insider purchases. Management and board members are aggressively stepping in with their own capital, right at our key technical support levels. They aren't worried about the short-term integration noise because they have full visibility into the true cash flow generation. When you see a chart compressing like this, overlapping with heavy insider accumulation, it creates a high-conviction, asymmetric setup for capital allocators. So what is the stock scope verdict? We are rating Amcor, a moderate accumulation on a margin of safety. We are not issuing a blind strong buy today, because a $15 billion debt load always requires strict monitoring in this interest rate environment. However, the $3 billion free cash flow generation provides an immense, undeniable margin of safety. Avoid the emotional selling based on short-term integration friction. If you can accumulate shares alongside the insiders during this algorithmic weakness, the math is heavily in your favor. Respect the yield, trade the cash flow, and make sure you subscribe to StockScope for our next institutional deep dive.